In this teaching, I'm going to go through the golden bullet setup, the entry criteria, where your stop loss should be, where your take profit is, and I'm going to do this with a live trade that I took on Euro USD. By showing you a live trade, I can relay my thoughts, exactly what I was thinking during the trade, the emotions I was going through, any FOMO, and in this way, hopefully you will start to understand how you can look out for the signs of a golden bullet presenting itself, executing it without fear, and then trusting that the strategy will play out. Now, going through the entry criteria first, we have to ensure that we haven't already taken 2 losses for the day. Every trade we take must align with our daily bias and have a clear drawn liquidity. So once those 2 have been established, we only look at the M5 time frame. That's where the strategy plays out. And then we are looking for candles to be sensitive to the 27 power of 3 GB levels. So by sensitive, I mean that the candle wicks all the bodies open or close exactly on a GB line. And I'll show you an example of what I mean there. And by exactly, I mean you could take the price tool, put it over a candle wick, and then see that the price matches the GB level price. We then need an M5 sweep of liquidity. So even ICT talks about this a lot, where his son's algorithm requires a sweep of liquidity before he enters. And he also spoke about high frequency algorithms in the real world only ever execute after there's been a sweep of liquidity. After the sweep of liquidity, we need to check that there was an order block which formed in the order block GB level, again on the M5 time frame. Finally, we wait for a fair value gap in the fair value gap GB level. We do not execute until we have a classic ICT fair value gap, but it has to be in that GB level. And then, very important, we set a limit order in the fair value gap GB level. So not on the fair value gap that you see that the candle has created. You literally find the exact price that the fair value gap GB level is at, and then that's what you use as your limit order. We always have our stop loss at the low or the high. So this is 0 or 100 as per the GB price. And we always, no matter what, we always TP at EQ. This is at the 0.5 level. Now looking at the live trade, so this is Euro USD on the 5-minute time frame. You will see that this candle here, the wick, touched the bottom of the breaker block's GB level exactly. So the 0.29 level, which shows that we are sensitive. There are other cases here, and there were some cases off of the screen on the left. Down the bottom, you'll see that we have swept H1 liquidity. It's always important to mark your liquidity, because sometimes when you're zoomed in on these 5-minute candles, it's very difficult to see whether we've swept liquidity or not. So 2 conditions are already taking place. We are sensitive to the 27 level and we've swept liquidity. This candle here looks very much like an order block. So it's a down closed candle, and if you see it, the body of it fills a significant part of the order block GB level. So a lot of our entry criteria has now been fulfilled. The last thing we are waiting for is a fair value gap to form in the fair value gap GB level. Again, all of this is on the M5 time frame. However, the liquidity can be on any time frame higher than M5. In this case, it's an H1 low that we swept. So now all we are waiting for is for the fair value gap to form in the fair value gap GB level. And we need a significant part of that gap to be in that fair value gap level. You will see now that we have that fair value gap in that fair value gap GB level. And it's that only after we have a confirmation of that fair value gap do we place our limit order. Now again, our limit order, the buy is at the fair value gap GB level. So the exact price, where if you hover your cursor over that 0.17, the top of the fair value gap, you get a price. That's where your limit order is. We have our stop at the low, and then we have our TP at EQ. Now, in this way, we bypass the issues that I had trying to strictly trade algorithms 1 and 2, where sometimes you would think an algorithm 2 is running, so it shouldn't go below the fair value gap GB level, but it did and it stopped me out. Or you think an algorithm 1 is running, so typically you would put your limit order at the OB, where it might go to the fair value gap and take off. Again, I saw cases where we had a physical fair value gap, a candle fair value gap, and I would place my limit order there for price to only hit the GB level exactly and take off. So this takes into account the practicalities of executing a gold-back algorithm, and this allows you to deal with constraints in the real world, such as broker spreads, broker wicks, and this entry is very forgiving, and it will give you a 1.93 RR every single time, as long as you have put your limit orders at the right places, and your stop loss at the low or the high, the 0 or the 1, and then your TP at EQ. Now please note, we have not been tapped into the trade yet. So even though the trading view screen shows that we have been touched in, if you look at my MT5 on the left, the limit order has been placed. So we are still waiting for a retracement back in. It was just the way that I'd set up the tool, the buy sell tool. It looked like I'd been tapped in, but I haven't yet. Now we have to trust the strategy, right? Price is running away from us. So firstly, we do not FOMO and take a market order trying to ride what we think is the algorithm to EQ and TPing. A number of reasons why. Firstly, we have to trust that the algorithm will return to the fair value gap and tap us in. We cannot take market orders using this strategy. By the time you take your market order, you will have been slipped a little bit, and then our 1.93 RR that we need will not be 1.93, it'll be closer to 1. And then if you times that by the win rate, it just won't be a profitable strategy. So if this is the golden bullet playing out, you set your limit order at the fair value gap and you trust that you will be tapped in. Also, we do not cancel the trade thinking we've missed the move. The only time we cancel the trade if we haven't been tapped in is if price goes past EQ and our order wasn't filled. At that point, yes, the algorithm is gone and we didn't get into the golden bullet, and it probably wasn't a golden bullet anyway. At that point, we cancel the trade and then we move on. Now, even I was going through two emotions. So the first emotion was FOMO. The move is playing out without me. I have to market order. I have to get into this move. Fortunately, I've executed 100 golden bullets, so I trust that if it is a golden bullet, it will tap me back in. And the second emotion I was feeling on the day was fear. Fear that the move had gone, so I would cancel the trade. Because according to classic gold-back theory, if this is algorithm 2, we should retrace from the breaker, where in fact we were already in the mitigation block. So I had the fear of missing the move, so I wanted to market execute, and then I also had the fear of me never being tapped into the move and wanted to cancel the order. But you have to trust the strategy and know that if it is a golden bullet, you will be tapped in. So at this point, we still haven't been tapped into our limit order, but now we have this big red bearish candle coming down hard. Now, though we wanted to be tapped in on this trade, it almost TP'd at EQ without us, and now because of this big red bearish candle that's forming, it's very tempted to get afraid that this is going to take you out and stop loss you out the trade. Again, you have to trust the GB levels and you have to trust the strategy play out. And on the day, I was half inclined to cancel the trade. But you trust the strategy is going to play out. You trust that it will tap you in and it will TP you at EQ. This is critical. The market will do whatever it can to scare you out of trades. It will do things like fill 50% of a fair value gap precisely and then go up higher to create liquidity. So everyone else would, the ICT traders will say, hey, look, 50% of the imbalance has been filled. We've had an institutional order flow entry drill. Let's execute as a market order and put our stop loss under that little low. We don't do that. We trust that the fair value gap only forms in the fair value gap GB level, and that's where we take our entries. We don't trust any of this internal liquidity. It's purely inducement or to either scare you out of trades or force you to get into trades early. Now we are finally tapped into the trade. So you can see on the left, my MetaTrader 5 has executed the buy order. Now something I really love about this strategy is once you are in the trade, it does not take very long at all for you to TP, right? And ICT said this himself. When you're in a good trade, Price doesn't meander, it doesn't mess around, it goes from your entry to take profit as quickly as possible. The reason being, it doesn't want anyone else to get into that move. That is a quick move, and it's very satisfying when you execute golden bullets. Yes, you have to wait a while for them to occur sometimes. As you saw, it was creating all kinds of inducement. But once you are in the trade, the drawdown is very slight, usually, and then you TP very quickly. So that's pretty good for your nerves and your emotions, and it means you can get on with your day. So look, within 2 candles, within 2 5-minute candles, we had been tapped in and we had TP'd. You'll see this big green candle that formed after we were TP'd at EQ, and we always TP at EQ. The emotion that goes through your head now is, wow, I should have TP'd higher. I should have TP'd at the logical high of the algorithm 1 or algorithm 2, which is the opposite order block or the opposite rejection block. I have tested this strategy, and I have tested algorithms 1 and 2. The logical place to TP is at EQ. And even though this candle looks extremely bullish, you will see that it reverses and then it stops everyone else out. Whereas we are done for the day. We have executed our golden bullet, we've taken profit, we got our 1.93R, and then we can get on with the rest of our day. Because ultimately trading is about freedom. It's not about being in front of the charts. It's about making the money you need to make, and then you're done for the day. Now I'm going to zoom out and show you the confluences, the ICT confluences we needed in order to execute this trade. So it's not just about seeing a golden bullet entry take place. You need, firstly, that entry to be in line with your daily bias. And for us, we were looking for the prior day highs to be taken. So that was our first daily bias. We needed a sweep of liquidity. In this case, it was an external 1 hour liquidity that was swept. We also had the Asia session high intact, and in this case they were relative equal highs. So this was a very obvious drawn liquidity which matched our daily bias, which was bullish. You'll see here that we had our M5 candles being sensitive to the 27 GB level. This is a prerequisite of the golden bullet playing out as well. And this is basically time and price coming together and putting you on high alert that we may have our algorithm running on the 27. Now again, as per classic Goldback theory, something like an algorithm 2, if it forms a fair value gap in the fair value gap level, you should have a return from the breaker. In this case, we had a return from the mitigation block. And these are the lessons I had to learn over the last 6 months, and to see how the algorithm actually plays out in practicality and how you can make sure you're in those high probability setups. Because in the past, when I saw the candle and price getting into the mitigation block and we hadn't filled the fair value gap level yet, I would cancel the trade, only to realize it was still tapping in. So this is where my experience and thousands of dollars of investment in lost trades helped me to refine the golden bullet. Now this part is key. We need, on the M5 time frame, we need an order block that's created by a candle which fills a significant part of the order block GB level. I don't mind if it overlaps and goes slightly into the fair value gap, but I do need that body to significantly cover a big proportion of that order block GB level. Now again, we don't put our limit order at the physical candle fair value gap that we see. We put it at the GB level. There's been too many trades where it would miss the visible fair value gap only to hit the fair value gap GB price exactly and take off. So this is again where my experience comes in and says put that limit order at the fair value gap GB level. And this also allows you to have a fixed TP. So your RR will be 1.93 because you're always using the exact same prices, the exact same levels on the 27. Now to begin with, while you're learning the golden bullet strategy, I only want you to select one asset. I don't mind if it's EU or GU. GU is probably cleaner and easier to trade. However, once you're really good at the strategy, you might want to look at EU and GU both. So in this case, I was primarily monitoring GU, and you'll see that the candles are sensitive to the 27 GB level. However, price was being held around the breaker block level, whereas our point of interest is the OB level. It was at that point I switched to EU and I saw we are already at the order block and we had swept that H1 liquidity. So I knew that the algorithm was probably going to play out on EU as opposed to GU. What I found with price in correlations between related assets is you typically have one asset that's the leader and one that's the follower. Now the leader will move and it will make logical sense why it's moving. It will, let's say, retrace from a fair value gap or an order block, but the follower will just move what appears to be randomly. It is just following the leader, and you've got to work out which one is the leader and then trade the leader. Don't try copying your trades from the leader onto a follower, especially if you missed the play or the entry from the leader. Now I do like time when it comes to an ICT confluence, so you can either use the ICT macros indicator, which will tell you the times at which algorithms tend to play out, and these algorithms typically go to address an imbalance or sweep some kind of liquidity. In this case, we were at 3:30 a.m. New York time, and as we know from being ICT traders, the high or low of the day is typically formed around this time. So the fact that I was having this sweep and the golden bullet presenting itself at 3:30 a.m. gave me extra confluence that we were going to play out at this time. Now, to reiterate, before we were tapped in, we saw that fair value gap starting to form, but price was running away from us. We just need to be patient. We don't chase price. We never execute a market order because we want that 1.93 RR. So that, in conjunction with our win rate, will make us profitable. If it's a golden bullet, it will tap you back in. So you have nothing to worry about. You just be patient and allow price to come to you. You never chase price. Now, finally, very important. Once you have your first win of the day, you close your charts and you're done, right? This is the Vegas strategy, which I've spoken about and I will create another video on. We do not want to give back our winnings. We want to win the day and then move on. Secondly, if we have 2 losses in a day, again, we close our charts and then we come back tomorrow. The golden bullet plays out every single day. The fact that we've already made 2 losses means either the market is not conducive to what we want, so maybe it's running on a higher time frame, or it's in some kind of seek and destroy pattern, or maybe mentally we're just not with it today. We're just not seeing the charts well, or we have a tendency to FOMO or revenge trade today. For those reasons, we just close the charts and move on. Trust the strategy. It will play out as long as you execute it strictly according to these rules. It is a consistently profitable strategy, but a strategy is only as good as the person who executes it. Always remember this.